Hey guys, we're talking about Ford today. Paul, this dead dying company, this thing's going to south quick. We better jump ship while we can. You compare this to a lot of EV car companies. Stupidly, you're a big dummy because they've just been around for 100 years. They survived. How many car companies have come and gone? 3,000?
More than that. It was 3,000 back in like the 1950s.
Warren Buffett always says that thousands of car companies have come and gone in the past 100 years. 3 have made it, and 2 of them went bankrupt. We'll talk about Ford. Paul, it's funny is, of all the EV companies that we sort of compare and contrast with Ford, they're not all doing that well this year in terms of stock price, including Tesla, which is down overall in this crazy market. But Ford is up big time this year.
Yeah, it was at start of the year. It was basically at $8 a share, and now it's at 15. People make fun of me for saying when I talk about Tesla's not Ford. They're like, you're comparing Tesla to Ford. Yeah, because I look at their gross margin. And I look at it saying, if you take out Tesla's check from the government, they have pretty much the same gross margin. They make cars. There's nothing. What's the proprietary with Tesla's electric vehicles? Because last time I checked, there's a ton of car companies making electric vehicles. I own a Porsche Taycan, all electric. Mm-hmm. So maybe Porsche is infringing on Tesla's patents. No, they're not. So I look at this and I look at Ford, and the reason I want to talk about Ford is you'll be able to see what a car, and I'm not saying Ford's a great buy. I own Ford at $7 a share. I sold it at like 13 or 14, and I don't have it anymore. But I want to look at it and say, hey, here's a company that we can probably assess what they're going to be doing in the next 5 to 10 years.
Yeah.
Right?
For sure.
So here's our software behind us. We created this because all of our users wanted to get it. More on that later. But Ford is a $62 billion company. Their price to sales ratio, 0.45. What that means is for every dollar of sales they have, you have to pay 45 cents for the company. So it's $61 billion. They're roughly $136 billion in revenue. There you go, right there, okay? Their 5-year PE is 21.74, which is a check mark. We want it less than 22.5. Their return on invested capital in the last 5 years is 8.5%. We want it greater than 9%, so it's an X, but it's not much of an X. Gross margin of 14.5%, bottom line margin of 2.5%, okay? 5-year free cash flow, $12.4 billion. Last year's free cash flow, $15.2. Keep in mind that the last year has seen an increase in demand for new vehicles.
Yeah.
Right? So these car companies are probably flossing all these vehicles out the door. Right?
What Paul's doing is using our 8-pillar analysis to look at the financials of a company and see if the stock price is in line with this. We will also head over to Mo later in the video to see if people are trading Ford at a quicker pace. And you can do that in our Bid and Ask Nation, our community. We'll get to that in a minute. Go ahead, Paul. This is pillar number 3, revenue growth.
153.6 down to 136. That's an X, declining revenue. They're doing about the same revenue they did 10 years ago. Net income, 3.81 down to 3.42.
Yikes.
Shares outstanding, 3.98 to 3.99. So X there too.
Uh-oh.
Let's go to their cash flow statement first.
Okay.
Annual cash flow statement. Big time cash flow. Average of $12 billion over the last 5 years. Growth from 12.86 to 18.5. So this is growing. 11.94 billion is their average of the last 5 years. Their market cap is 60. So they're selling for 5 times free cash flow, guys. Wow. We usually want to pay 20 times free cash flow, which would take this to $240 billion.
Oh, wow. You mean, so the market cap of 240 and it's currently 61.
Yeah. So here's the interesting part. We usually have all green checks here and two red ones.
Yeah, if it's overvalued.
It's the exact opposite here.
What does that mean?
I don't know what that means. It looks like, guys, it looks scary here. They're increasing their shares slightly. They have a lot of debt, 10.5 times their last 5 years free cash flow. That is a lot. Revenue growth is down. I don't worry about this one as much. It's pretty close, and it's a car company. I'm actually kind of surprised it was even 8.5%. So I'm looking at this saying, the free cash flow doesn't match up with the earnings. I don't know why that is. Their earnings are showing $2 billion. Their free cash flow is $18 billion. That's a big difference. So you're going to want to understand why their free cash flow and the earnings of the last 5 years are so different. They have 4 times more free cash flow in the last 5 years than earnings. I don't know why that is.
In general, you don't love investing in car companies anyway.
I don't like investing in car companies, and here's why. I don't like the labor issues. I don't like it when, listen, more power to anybody who makes the money, but but I don't believe a janitor should make $100,000 a year. I think the unions are very strong, and as much as people might say they like that, at the end of the day, it's only costing the consumer more money.
Well, the workers like it.
Well, the workers like it a lot, but then it's less accountability for the workers. There used to be a joke. I used to work in an automobile seller in Toledo, and there was a joke: don't buy a car that was manufactured on a Friday, because we had incidences where people would report rattling in their cars more than one time, and it was a beer can inside the car. Not inside, inside of the floor, like within the, open the door up, pull it apart. Oh, there's a beer can there.
What?
Yeah, and I remember, listen, we all have our statements. Everybody says, oh, unions are very important, et cetera. Maybe so, but using the same argument, the number of union employees from 1980 to today are way lower. We have a manufacturing site that's going abroad. And at the end of the day, you have to sit there and understand that, guys, manufacturing going abroad for a reason. You can't pay somebody $50 an hour to be a janitor and expect that that's going to be okay it's going to make money for a car, but it's just going to be very, very difficult. So you talk about competitiveness and things like that. I just look at this saying it's just hard. You look at the car manufacturers in general. It's a very difficult business, underfunded pensions, all these things I look at going, it's really hard for me to look at this income statement and feel comfortable seeing where profit's going to be in the next 5 or 10 years. I mean, look at this. Look how all over the board it is. 18 billion, 6 billion, 11.5, 2.2, 8.5, 3.8, 6.92, lost 2, made 3.4. I just don't know where it's going to go. To me, I just feel icky inside about it. Unless it's selling for an insanely low number, which at $7 a share it was. I think it was selling for 2 times free cash flow. I would just avoid it. But for me personally, I just avoid. It doesn't mean I'm right. It just means for me personally, I would avoid it.
And for a normal 35-year-old investor with maybe $100,000 or $200,000, I mean, what do you think they should do?
I think you should do it. If you know Ford inside and out, you know it very well, and you feel very confident with it, go for it. I just don't look at these numbers thinking to myself, this is a pretty obvious. I mean, the cash flow statement, I would not understand why the cash flow and the earnings are so different. So different. Change in working capital was the big driver here. The last 2 years. Look at their net income in the last 2 years. They lost in net income $1.2 billion, but their free cash flow was $28 billion, $28.5 billion. Lost 1.2 in earnings, made $28 billion in free cash flow. I don't know. It just confuses me. You got to remember, whenever something is that confusing to me, some people say, well, pull it apart. Yes, you'll probably find better opportunities there. I just go, I'm lazy, I'm moving on. That's just my take on it. I'm sure from a trading perspective, it's probably pretty decent.
Yeah, Mo, did people in bid and ask get some of that action? Oh,
actually, they do. They do this. They trade forward a lot. And right now, it's actually looking like a pretty good trade. Now, the only issue you have is right up here is a high from the past year or something, $16.45. So you'll probably face some resistance up there. But to me, if you get a green engulfing candlestick like that, at some point, go for it. Now, you have earnings on the 26th, 27th. So be careful of the earnings that are coming on the 27th. But besides that, I mean, it's looking really good. It's overall 4 major moving averages. You're getting pretty decent volume that's coming into the stock on a consistent basis right there.
You tell people not to get too frisky around earnings reportings, right?
Yeah, I don't like trading earnings just because it's a total crapshoot. And the more times that you're in a stock on earnings, now if this is from a trading perspective, I'm not talking about it from a value perspective, but trading it, if you're in it and the earnings are great, stock price can go way down on you and vice versa. So to me, it's just not worth the risk. Some you'll win, some you'll lose, but more often than not, as a whole, you're going to lose. So I'm careful around earnings and I'm not in the position.
Paul, do you think the term crapshoot has to deal with a toilet or actually throwing dice in a
Probably throwing dice. It's all one big crapshoot anywho.
I was talking about a toilet.
What's that from?
Okay.
Come on, you. Groundhog Day. It's one big crapshoot anywho. I have friends who live and die by the actuarial tables, and I just say, it's one big crapshoot anywho.
I can't believe I didn't get that one. I watched Groundhog Day like hundreds of times.
I'm disappointed. So guys, now I want to look at the stock analyzer tool. So when we created the software, one of the things I wanted to give our users was a way to evaluate a company and give them a stock price they should pay. Now, what this allows you to do is pick the number of years you want to analyze, and I'm picking 2 different numbers, assumptions. I'm going with no revenue growth in the next 10 years and 2% revenue growth. I'm trying to be conservative. Share change, 0.5% increase a year versus 0. Profit margin 2 to 3. Now here's where the difference is. The cash flow margin and profit margin are very, very different. I actually shouldn't even go 6 and 8% here. because it was over the last, I should go 4 and 6. PE, 10 and 14. Free cash flow, 10 and 14 and 12.5% return. Analyze. So guys, from the earnings, multiple of earnings, it's overvalued. Now that's my point. You have to understand why earnings and free cash flow are so different. And only from one of these areas on the high side is the free cash flow making sense. But is it unreasonable to say 2% revenue growth? I mean, that doesn't seem unreasonable. However, I would say that the last few years have been very, very good for revenue for the companies, for these car companies, and they're having a hard time manufacturing enough cars. So I don't know. I'm just passing on. I bought Ford last year, loved it, bought it at 6 or 7, sold it at 13 or 14. I don't remember exactly, but I made my money and moved on.
That's what take. Be careful with the car companies. Yeah, they're tough. Thanks for watching the video. Fondle the thumbs up. Join our community, and you can have access to
Follow us on
software.
Instagram.
Follow us on Instagram. And see you next video. Thanks for watching.